The promotion had already been reflected in his direct deposit for 6 months before he noticed how little space remained around it. By the time the salary increase felt normal, the higher insurance premium, the upgraded commuter parking pass, and the larger mortgage payment had already settled into the background. He was 42 when the title changed. Senior manager replaced manager in the company directory, and the annual compensation crossed into a range he once associated with executives. The role came with more predictable bonuses, broader oversight, and a schedule that no longer required weekend travel. Stability had finally arrived in a form that looked permanent. The family responded in ways that felt proportional. The previous house, a three-bedroom colonial purchased during his early 30s, had appreciated steadily. The equity was real. Mortgage rates were still competitive at the time of the move. Their second child was approaching middle school, and the district lines mattered more than they had before. The new home offered an extra bedroom, a finished basement, and a quieter street with longer driveways and fewer rental properties. It also carried higher property taxes, homeowners insurance that reflected updated replacement costs, and utility bills that no longer dipped during mild months. The payment fit the spreadsheet when they closed. His wife had returned to full-time work 2 years earlier. Together, their income placed them squarely in the upper tier of middle-income households in their metropolitan area. Retirement contributions increased automatically with the new salary band. Health insurance options expanded. The benefits summary read like a confirmation that the long stretch of career building had worked. They replaced one vehicle that year. Not a luxury model, but newer, safer, with lower maintenance risk. The monthly payment was manageable. The interest rate was acceptable. The warranty provided reassurance. Their daughter began travel soccer. The registration fee was higher than the local league, but still reasonable when viewed against their income. Tournaments required hotel stays a few times each season. The cost accumulated gradually, not dramatically. None of it felt reckless. At 43, he noticed that annual raises no longer felt like gains. They felt like adjustments to keep pace with existing obligations. Bonuses were allocated before they arrived. Some toward the 529 plan, some toward the kitchen appliance that had begun to fail, some toward replenishing savings after a year with multiple out-of-pocket medical expenses. The company remained stable. Layoffs had occurred in other divisions, but his department was considered core to long-term operations. His performance reviews were consistent. He was not concerned about unemployment. The career path appeared steady. Yet, the margin between income and fixed expense had narrowed compared to 5 years earlier, when his salary was lower but his commitments were smaller. The mortgage alone accounted for a larger share of monthly cash flow than he anticipated when they signed the papers. Property taxes adjusted upward after reassessment. Insurance premiums rose in response to regional weather claims. None of these increases were dramatic individually. Together, they reshaped the baseline. Childcare had once been the dominant expense. That line item disappeared as the children grew older. In its place came extracurricular commitments, technology upgrades, school fundraising expectations, and the quiet social pressure to keep pace with peers whose parents held similar titles and incomes. Career stability brought social stability. Their neighborhood reflected it. Most households had two working professionals. Driveways held late model SUVs. Conversations at block gatherings referenced college tours, 401k matches, and corporate restructuring in distant offices. No one appeared strained. At 45, he began to understand that stability had allowed expansion to occur without resistance. When income fluctuates, households hesitate. When employment feels uncertain, families defer decisions. But when a paycheck has arrived consistently for years, when the company's stock price trends upward, when the health plan renews each January without disruption, it becomes easier to interpret permanence as a given. They refinish the basement in stages. First to flooring, then built-in shelves, then a sectional sofa large enough to host extended family during holidays. Each upgrade was paid for responsibly, often with cash from savings. There was no revolving credit card balance, no missed payments, no outward sign of financial stress. But the cost of maintaining their chosen standard of living continued to rise in quiet increments. Their grocery budget increased with teenage appetites. Auto insurance adjusted after a minor fender bender involving their son's learner's permit. Internet service upgraded to support remote work flexibility. Streaming subscriptions accumulated. None of these felt like luxuries. They felt aligned with their position. At 47, he reviewed their annual spending summary and noticed something subtle. Discretionary spending had not ballooned. Dining out remained occasional. Vacations were domestic and modest. They were not accumulating luxury watches or high end electronics. Yet, their total fixed and semi fixed commitments consumed a higher percentage of income than during the earlier, less stable years of his career. The difference was structural. The larger home required ongoing maintenance at a level the previous one never demanded. Landscaping contracts replaced occasional weekend yard work. A new HVAC system, though financed at a favorable rate, introduced another monthly payment layered on top of the mortgage. The property itself dictated a baseline of spending. Career stability had reinforced the assumption that they could sustain it indefinitely. He began to notice colleagues in similar positions making comparable adjustments. Promotions often coincided with moves to more expensive neighborhoods. Title changes frequently preceded private school enrollment or expanded travel commitments. None of it was discussed as escalation. It was described as alignment with life stage. There were no abrupt turning points. No single decision that dramatically altered their finances. Instead, each year added a layer. Retirement contributions increased automatically as a percentage of salary. This was prudent. Yet, higher income also placed them into tax brackets where marginal rates climbed, reducing the visible impact of raises. Healthcare premiums edged upward annually. College savings contributions expanded as tuition estimates grew. The financial architecture became more complex. At 48, he calculated the minimum monthly amount required to maintain their household without disruption. Mortgage, property tax escrow, insurance, utilities, transportation, food, education savings, healthcare premiums, and baseline discretionary spending formed a number that felt immovable. It was substantially higher than it had been 5 years earlier. He did not regret the house. The children had space. The schools were strong. The commute was reasonable. The neighborhood felt secure. These outcomes were tangible and visible. But he recognized that his career now functioned less as a vehicle for upward mobility and more as a support beam holding up an expanded structure. When he imagined reducing hours or shifting to a lower paying but less demanding role, the numbers resisted the idea. Not because of extravagance, but because of commitments already embedded into daily life. The two income model amplified this effect. His wife's salary contributed meaningfully to retirement savings and college funding. It also underwrote aspects of their lifestyle that would be difficult to reverse without noticeable change. If one income paused, the system would strain. Not collapse, but strain. Their financial life looked disciplined on paper. They maxed out retirement contributions in strong market years. They maintained an emergency fund covering several months of expenses. They avoided high interest debt. Yet, the cost to maintain their version of stability had grown alongside the stability itself. At 50, the children approached college age. Campus visits required airfare and hotel bookings. Application fees accumulated. Standardized test preparation added another line item. Tuition estimates, even for in state public universities, exceeded what he had paid for his own degree by multiples. The 529 balances were substantial, but not sufficient to eliminate loans entirely. He understood that student borrowing would likely be part of the equation. The career that once symbolized freedom now represented continuity. Each year of steady employment ensured the mortgage payment cleared, the insurance policies remained active, the college accounts received contributions, and the household operated without disruption. He observed that his professional risk tolerance had declined. Opportunities that once might have intrigued him, a startup role, a consulting pivot, a temporary sabbatical, now appeared incompatible with the fixed structure he supported. He did not articulate this as regret. It was simply a recognition that expansion had followed stability, and the two had become interdependent. In conversations with peers, he heard similar patterns. Raises led to relocations. Relocations led to higher property taxes. Higher taxes required sustained income levels. Sustained income levels discouraged career volatility. The loop was subtle but consistent. The company offered a voluntary buyout package 1 year during a restructuring phase. It included a lump sum payment and extended health coverage. Younger employees without mortgages or dependents considered it. He calculated the offer against his annual obligations and closed the email without responding. The buyout was generous by objective standards. It was insufficient relative to his baseline. By 52, the mortgage balance had declined, but interest payments remained significant. Home equity had grown further, partly due to regional appreciation. On paper, net worth increased each year. Liquidity did not. Selling the home would unlock value, but also require entering a market where comparable properties carried similar price tags. Downsizing was possible in theory, but emotionally complicated, while the children still lived at home. His salary continued to rise incrementally. Performance bonuses fluctuated with company earnings. Retirement accounts benefited from strong market periods and retreated during downturns. Over decades, the trend moved upward. The sense of optionality did not expand at the same pace. He began to understand that career stability had not only provided income security, it had encouraged a structural expansion that assumed the continuation of that security. Each layer of cost was rational when introduced. Together, they formed a fixed ecosystem. By 54, with one child graduated and another midway through college, the household expenses shifted again. Grocery bills declined slightly. Travel soccer ended. College tuition payments replaced them in larger, less flexible installments. The house felt quieter. Maintenance did not decline proportionally. He sometimes reviewed earlier bank statements from his late 30s. The total monthly outflow was lower by thousands of dollars. Income had been lower as well, but the ratio between fixed commitments and take-home pay had left more breathing room. Back then, instability felt threatening. Today, stability felt necessary. The career remained intact. Health was stable. The mortgage amortization schedule projected full payoff in less than a decade. Retirement account projections indicated adequacy if markets performed within historical ranges. From the outside, the trajectory appeared responsible and successful. Inside, he recognized that each step forward had reinforced the need to continue stepping forward at the same pace. The expansion had not occurred because of extravagance or mismanagement. It had occurred because stable income signaled permission. When stability persists long enough, it reshapes what a household considers normal. A larger home becomes standard. Higher insurance premiums become routine. Increased tax obligations become background noise. The career that created these conditions remains essential to sustaining them. As he approached his mid 50s, he noticed that conversations about early retirement felt theoretical. The numbers could be modeled, the projections could be calculated, but the structure of his household, its size, its location, its embedded expectations, had been built during years of dependable income. That structure now required continuity. The original promotion had seemed like a milestone. It was. It also marked the beginning of a gradual recalibration in which stability encouraged expansion, and expansion reinforced dependence on stability. The direct deposits continued to arrive on schedule. The commitments continued to clear.